Broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and thank you for joining us for today's webinar on analysis of the Union Budget 2020. The Union Budget 2020 has been duly positioned as a game changer for the country's economy. The Finance Ministry has a mammoth task of improving GDP, resurrecting the affected sectors, and reviving a debilitating economy overall. Apart from a structural change in the tax slab, fiscal growth and improved tax reforms are said to be a crucial part of the budget. Joining the discussion today are Nishit Parekh, practicing chartered accountant, and Shivendra Dwivedi, senior manager indirect tax, Nexdigm SKP. Both speakers have extensive experience in the area of tax. Before we begin, kindly note that all our listeners are in listen-only mode. If you have any questions, please share them with us through the question box on the right-hand side of your screen, and we will address your queries at the end of the webinar. We are happy to host today's webinar for all our listeners. Without any further delay, we shall start the webinar. Over to you, Nishit and Shivendra.
Good morning or good afternoon, everyone, wherever you guys may be. So I am going to cover the direct tax part of the budget changes, and my colleague Shivendra would be covering the indirect tax changes. So before getting into the direct tax proposal, we want to highlight some of the important facets on the microeconomic side which the government had mentioned during the course of the budget. The government's focus, the Indian government's focus is mainly going to be on three themes which they mentioned in the budget. One is aspirational India, where they want to provide access to health to everyone, have a new education system so that India becomes an education hub for the world, and employment generation was one of the important factors which was discussed in the budget. Due to the slowdown which is happening overall due to the trade war and other issues which are happening. So employment generation was one of the important aspects which the finance minister discussed during the budget. On the economic development side, the government reinsured their focus on developing the economy, including the relevant infrastructure required to carry out the dream of becoming a 5 trillion economy in next few years. From an economy perspective, India already is the fifth largest economy of the world and third in terms of the purchasing power parity. The government has projected a 10% nominal GDP growth rate in next few years. One of the concern this year was on the fiscal deficit side, whether India will be able to meet its target or there would be a huge deviation. But the guidance provided by the finance minister is that Indian fiscal deficit would only be 3.8% as against the predicted or the forecasted one of 3.5%. And they have assured that for 2021, 3.5% would be achieved on the fiscal deficit side. Government, in order to meet the fiscal deficit targets, is looking at a lot of disinvestment of public sector companies to the investors so that a lot of funds can flow to the government. On the infrastructure side, there have been a lot of development on the highways. Around 15,500 kilometers of highway projects have been undertaken. Electrification of around 20,000 kilometers, 27,000 kilometers of railway tracks has happened to push the agriculture in India. A lot of schemes have been announced, including providing 15 trillion INR agricultural credit, introducing Kusum scheme, which covers farmer for standalone solar pumps, and building a seamless national cold supply chain. And as we discussed, education is one of the focus, and to push that new education system, government is going to come out with a new education policy. Also, in order to get investment into this sector, they are going to come out with changes to the foreign currency loan, that is the external commercial borrowing regulation, as well as the foreign direct investment in this sector, so that in getting investment for the education sector is easy. For the MSMEs, a lot of work has been done on ground A Nirvik scheme for higher insurance for exporters has been introduced. Technology upgradation projects have been taken up by the government. On the financial service sector side, there were one or two issues in terms of cooperative banks in India coming under risk of being in danger because of certain accounts turning into NPAs. But in order to assure the depositors in the banking system, the government has increased the limit of the insurance cover from zero point 0.1 million to zero point 0.5 million INR for depositors. MSME debt restructuring has been extended to 31st March 2021. The India's biggest life insurer, that is a life insurance corporation, is being evaluated, or rather it is announced that they are going to get the same listed on the stock exchanges and do a disinvestment, which unlocks a huge potential for the government in terms of funds which will come into the government's kitty by this big disinvestment. On FPI side, in order to encourage more fund flow into India in the bond market, the limit of the FPI for investment into the bond market has been increased to 15% from earlier 9% which was there. So now, before getting into the key changes which were announced on 1st February 2020, I would like to take a step back and go to the day of September 20th September 2019, where certain big bang reforms were announced by the government, where India had one of its huge tax rate cut for the corporates. The government, through an ordinance, announced that for all corporates, the tax rate was slashed from 34% effective to 25% effective tax rate. And for manufacturing companies which are setting up into India from the period October 1, 2019 and commences manufacturing before 31st March 2023, the tax rate would be only 17%. So this is one of the most competitive tax rates globally which has been provided in India for manufacturing with the ongoing excuse me, with the ongoing trade war and companies looking to shift from China to India. India has come out with this very good opportunity for large MNCs to set up their manufacturing hub in India. There are certain conditions to be fulfilled to avail these benefits, but those are pretty straightforward and simple conditions which can be easily complied with. So technically, what we are looking at is India can be the next manufacturing hub for the global markets. And there are multiple reasons to come to India. One is the skilled labor, which is available in abundance because of the population in India, and also the cost arbitrage. Labor cost in India vis-a-vis the Western world is comparatively lower. That could be a good cost as arbitrage for MNCs. Plus, the tax and the regulatory system year-on-year basis is getting simplified to some effect, whereby the tax rates have been rationalized to meet the global standards. Plus, the tax assessment, the revenue audit process is getting digitized. Introduction of GST in India, all of that uh, would or rather has created a path for a simpler tax regime. While the initial teething issues would be there, but overall we are set to become a manufacturing hub, and that's what the opportunity according to us lies in India, whereby a lot of investment may flow in next few years, till at least till 2023, till the time the lower tax rate window or the manufacturing setup window is available. So now this was the flashback, and now we come to the changes announced, which were on 1st February when the finance minister presented the budget. So one of the main expectation out of the Indian budget was since there were big cuts on the corporate tax side, there was a lot of expectation from individuals to reduce the tax slabs or the tax rates for them, and government has obliged and proposed a new tax slabs for the individuals. However, in order to avail those new tax slabs, the individuals will have to give up on the various deductions which they are claiming under the current regime. So effectively, what happens is that in most scenario, if your salary income or your income as an individual is higher than 1.5 million, or you are claiming deduction in excess of 0.25 million, then the old regime continues to be a better regime. But this new regime would be helpful to youngsters or the senior citizen who may not be doing many of the investment not claiming many investment linked deductions, and they may want to opt for the new scheme. There were certain changes in the residency law. So any Indian citizen who is going outside of India and returning back to India, earlier he used to be considered as a resident of India if he used to spend 182 days in India. Now that limit has been reduced to 120 days. Further, for qualifying as an ordinary resident of India, you need to be a resident of India that satisfy the criteria of 183 days, and in additionally you were required to satisfy two more conditions, which was presence of 730 days in last 7 years and being a resident in 2 out of 10 years in last resident in 2 years out of the last 10 years. Now that condition has been deleted, and instead of that only one condition remains, whereby an individual would be considered as a resident and ordinary resident only if he is a resident in India for 4 years in any last 10 years. So this is very helpful for expats who are coming to India, because earlier after staying in couple of years in India, they were becoming resident and ordinary resident in India, which was resulting in taxation of their global income into India. But now with this change, the expats would ideally become residents only after 3 or 4 years, depending on the time when they came to India. So this is a welcome move for the expat community. However, the Indian citizens who frequently visit India but are preliminarily working outside of India may find it difficult to avoid being an ordinary resident in India and may become liable to pay taxes on global income in India. Further concept which is concept which is globally accepted of a stateless person has been introduced in this budget, whereby an Indian citizen who is gone outside of India and is not paying tax in any of the country or trying to avoid paying tax because he is visiting multiple countries and not becoming resident of any of the country. So now he would be taxed in India, as there are certain deeming provisions to treat him as a resident have been introduced in the budget. Moving on from a foreign company perspective, there were various amendments which were made. So India had introduced a limitation of interest deduction, which is similar to a thin capitalization rule, whereby interest payments for loans was allowed only to 30% of EBITDA, and in that certain exceptions were provided in the earlier years when the budget were introduced. And in order to enable foreign company branches, banking branches in India to disburse loan, they have excluded them from the definition. So this is a welcome change. Further, as globally BEPS and OECD are working towards finalizing what are the unilateral measures each country should take to ensure that there is no tax avoidance or fair share of revenue is received by each country, and that report is to be finalized in 2020, the final BEPS report. So in line with that, significant economic provisions which were introduced a couple of years back are now being deferred by 1 year. So the government will wait for the final report from the BEPS and the OECD, and then basis that either reintroduce the SEP provisions, that is the significant economic presence provisions, in line with the report. Further, the source rule also has been amended. Certain items are now would be considered as deemed to arise in India. So if anybody is earning income from advertising, which mainly targets Indian customer, that revenue would be considered as to be accruing in India and hence may become taxable in India. Obviously, tax treaty benefits would be available. So till the time the tax treaties are not amendment, this may just remain on paper and may apply only in cases where treaty benefits are not available. Another addition was sale of data collected from India and sale of goods and services using such data. So if any data collection is happening in India which is helping the foreign companies selling goods into India, those revenue also may be considered to be taxable in India under the source rule, subject to the treaty provisions. Further, one exemption was provided on royalty taxation for cinematographic films that has been removed, and now even royalty earned in respect of cinematographic films would be taxable in India. Further, for European companies or US companies which have set up funds which are investing across the globe, including India, and they have a fund manager in India. So there were rules introduced earlier year which provided for the condition that even if the fund manager of a global fund is located in India, it would not constitute a permanent establishment in India, subject to satisfying various conditions which are provided under the law. So there were certain demands from the industry that these conditions are stringent and some of the condition needs to be lightened. So accepting those requests from the industry, government has has diluted couple of conditions. So technically, this fund is allowed to take only 5% investment from Indian investors. So they have now excluded the fund manager. If fund manager is investing in those fund up to INR 250 million, those investment would not be counted as Indian investment for calculating the 5% limit. This is mainly the concern was coming out that if a fund manager has to sell the fund, he has to put some money in the fund to show that he has the skin in the game. And if he's going to eat up the 5% limit, the Indian investor would not be able to invest in those funds. So this relaxation has been provided. Second, the fund was supposed to create an AUM of 100,000 million within 6 months from the end of the setup of the fund. So the funds which were actually set up in the later part of the year or towards the end of the year were finding it difficult to reach this stage immediately within 6 months. And also there was a disparity because the funds which were set up in the first part of the year were getting 18 months, whereas the funds which were set up at the end of the year were only getting 6 months. So this limit or this law has been now streamlined to say that the 100,000 million corpus or the AUM has to be done from the 12 months on the last day of the establishment or incorporation of the fund. Moving on, a couple of important changes was amendment of the Indian local laws, which empowers the government to enter tax treaties with other countries which do not provide opportunities for non-taxation or reduced taxation. So in light with the MLI and the BEPS project, now government has made an enabling provision under the law which would allow them to enter into tax treaties and ensure that those tax treaties does not result in non-taxation or reduced taxation for any of the taxpayer. And one of the biggest move or biggest changes which will impact a lot of foreign companies positively was on exemption from filing tax return. So earlier in India, as per the law, any company earning income from India was required to file a tax return in India. Only exception provided was for funds earning dividend income and interest income. So there are many companies which were required to file tax returns in India, even if they were earning some service income or royalty income from India. Now the government has provided all foreign companies which are earning interest, dividend, technical service, or royalty income from India would not be required to file any tax return in India, subject to appropriate taxes have been withheld by the Indian payer. And the taxes have to be withheld as per the local laws of India, which is around 10.92%. So there may be cases where the tax treaty provides for a 10% tax rate, but this exemption is available only if the foreign company agrees to pay 10.92% tax in India. While the amendment has been made for the tax return filing, there is no corresponding change or relaxation provided from transfer pricing regulations. So if a foreign company has transactions from with the related parties or the group companies in India, it will have to continue filing the transfer pricing reports in India. but tax return they can take a position that they are not required to file based on this amendment. So even after this amendment, there may be few cases where the tax return filing would be required. So cases where the payer deducts tax as per the tax treaty and not as per the Income Tax Act, that is a local law of India, then the tax return filing is required. This is mainly that if you are claiming a tax treaty benefit, then the government or the tax authorities in India would like to verify whether appropriate taxes have been deducted or not. So there are treaties like Netherlands or Singapore or US or UK where there is a favorable fees for technical services clause which provides for making available clause under the FTS. So if any company is claiming benefit of that clause and not paying any taxes because of that favorable clause in the tax treaty, or somebody is taking benefit of the independent personal services clause in the tax treaty, then all those taxpayers will have to still continue filing tax return in India. Again, any company which has actually approached the Indian tax authorities and obtained a ruling from the authority of advance ruling on the taxation of a particular transaction in India, and where it has been ruled that they are not required to pay any tax in India, tax return filing would be required. Then cases where foreign company does not have India tax registration number and they have been subjected to higher withholding tax rate as per the Indian local laws, then still the tax filing requirement remains. And any company earning, this we discuss mainly, if any company is earning income other than royalty, FTS, dividend or interest, may still have to file tax returns in India. And this was one of the biggest change of non-filing of tax return by foreign company. And to follow it up, one more big change was removal of dividend distribution tax. So in India, what was happening from 2003 was that any company which was declaring dividend, the Indian company itself was liable to pay a 20.56% dividend distribution tax. And once that dividend distribution tax is paid by the Indian company, all the shareholders, including the Indian shareholders as well as the foreign shareholders, were not liable to pay any tax in India. But it was observed that many foreign companies were facing challenges in claiming the tax credit of the dividend distribution tax in the home country, because this dividend distribution tax was paid by the Indian company and not by the foreign company as a withholding tax. And then that was creating a huge additional tax outflow for the foreign companies in the home country. And there was a demand by the industry of removal of this dividend distribution tax. So now this budget proposes to remove the dividend distribution tax, and whatever income dividend is declared now would be taxed in the hands of the shareholder, and it would be taxed as per the respective rates applicable to the shareholder. And so I'll take this slide first. So if you look at the scenario now, so if a shareholder is earning, say a US shareholder is earning dividend income from India and he is holding more than 15% shares in the Indian company, sorry, if he is holding more than 10% shares in the Indian company, the tax rate applicable would be 15%. Obviously, he will have to satisfy the beneficial ownership test, also file a tax return in India, but he will be able to claim a 15% tax. And if you look at countries like Germany, Netherlands, Hong Kong, UAE, the tax rate goes down substantially to 5 and 10%. And since it is a withholding tax which is paid by the foreign companies in India, they would also be eligible to claim tax treaty benefits in the home country and claim this credit in the home country. And in order to enable appropriate collection of taxes, government has also introduced the withholding tax provisions on this dividend, whereby from a resident shareholder perspective, a withholding tax of 10% would be applied, and for a non-resident perspective, it would be either as per the local laws of India 20% or as per the respective tax treaty rates, whichever is beneficial to the taxpayer. Similarly, amendments have also been made for the mutual funds, where if investments are made into mutual funds, the income from mutual funds also would be now liable to tax in the hands of the shareholder and not in the not in the hands of the mutual fund. So, for example, if with this example, we can see how the cash flow would increase substantially in the hands of the recipient or the shareholders. So, before the announcements in the budget, if an Indian company was earning 100 million INR as profits, it had to pay 20.56 million INR as dividend distribution tax in India, and the distributable surplus was only approximately 80 million INR. And again, this 80 million INR would get taxed in Germany, whereby German shareholder will not be able to claim that 20.56 million INR tax is paid by the Indian company as a tax credit. Vis-a-vis post-budget scenario, entire 100 million INR would be available with the Indian company to distribute. And if German shareholder can claim the tax treaty benefit, it will apply only 10% tax rate. It will only pay 10% tax rate in India, that is 10 million INR, and it will receive funds of 90 million INR. Further, on this 100 million INR, when it offers this to tax in Germany, it would also be in a position to claim the 10 million INR as a credit in Germany. So this from a foreign investor perspective, this would become a huge additional cash flow from India, from their subsidiaries or from their investments into India, and also at the same time enabling them to take tax credit in the home country. Moving on, certain changes were made on the interest payments. So if FPIs or QFIs invest in certain specified securities and bonds in India, there was a tax rate of 5% which was applicable to those FPIs and QFIs. And this 5% beneficial rate was expiring on July 2020. However, that limits have now been extended to July 2023. So this beneficial rate would now be available to all the QFIs and FPIs till 2023. Rate also municipal bonds have been included in the categories of specified bonds, and that will also now get a concessional rate of 5%. Further, if the investment is made in the International Financial Center, which is created in Gujarat, and an investment is made in certain bonds listed on those exchange, then the tax rate would be further reduced to 4%. Further, there is some small changes in the local withholding tax laws which have been made, whereby fees for technical services payment between two local residents in India has been reduced to 2% from 10%, and some benefits have been given to cooperative societies which locally operate in India. Further, India introduced withholding tax on e-commerce transactions. So, assuming a foreign player is selling on Amazon India or any other e-commerce platform in India, then whenever Amazon India or anybody other e-commerce operator would be making payment to them, they have been made liable to deduct tax at the rate of 1% if the seller who is listing on the website has a Indian tax registration number, that is a PAN, and if he does not have, then a 5% rate would be applied on those e-commerce transaction. Certain tax collection at source provisions have been introduced, that whereby an Indian resident making investment overseas under a liberalized remittance scheme of RBI, in order to track those investment and also ensure that corresponding compliances are made by that individual in the tax return side, a TCS, that is a tax collection at source, has been mandated to the authorized dealer. So whenever as an individual, if I need to make say $100,000 as a remittance for say education of my children who is studying abroad, then there would be a 5% TCS collected by the AD banker and deposited with the government, which would be available as a tax credit to the Indian resident. Further, in order to discourage cash payments to the local tour operator, the TCS has been imposed even on those local TCS operator. Further, again in the same line, to increase the tax base in India, if I am selling goods to someone and the value of the goods is over 5 million, I am required to collect certain taxes from his payments and deposit it to the government to ensure that the purchaser is also being compliant and reporting all its transaction and income into India. Moving on, certain important changes were made in terms of the tax litigation side in India. So India has already adopted revenue audit, which have become faceless, whereby entire proceedings have moved to a e-assessment stage, where entire assessment or the revenue audit proceedings are happening over emails and electronic modes. So this is mainly done to reduce the human interaction or the physical interaction between the taxpayer and the tax officers, in order to discourage any corruption issues which may arise or any biases which may develop between the taxpayers. So now it is proposed to take this to the next level and even apply faceless e-assessment proceedings to even appeal proceeding, that is the first level appellate proceedings in India. Also, for earlier, only dispute resolution panel was set up in India, which was mainly for the foreign companies and Indian companies having transfer pricing adjustments, whereby they can approach the dispute resolution panel for resolving the issues on the tax side. And there earlier, the foreign companies were able to approach only if the tax officer was proposing to change the income offered by the foreign companies in India. But if there was a change in the tax rate proposed by the by the Indian tax officer, the foreign players were not able to approach the DRP because of the typical language used in the law. Now they have made it straight, saying that for any dispute related to taxes, the foreign company can go to the dispute resolution panel, which is a welcome move. Further, in case you are fighting the case with the higher authorities, it has been made mandatory to pay 20% of the tax demand before fighting the case or going for a request to not pay the tax demands in India. Further, one important announcement which came in the budget speech was government is looking at creating a taxpayers charter to be enshrined in the statute, which would mean that the rights of the taxpayer against the tax department would come out as a law. And if things are not moving or there are issues around the same, then the tax then there would be legal recourse available to the taxpayer. It is to be seen that how the charter is prepared and how it is implemented. So this is something which everyone will be waiting to look at. Currently only the statement was made and we are awaiting the fine print of the charter. One big announcement was a dispute resolution scheme, whereby government has offered an amnesty scheme to close the outstanding tax cases which take a pretty long time to settle in India. So there are almost around 0.5 million cases pending at various levels of appeals in India. So government has come out with a scheme whereby taxpayer can agree to pay only the taxes, and all the penalties and the interest is waived off, and only on payment of taxes the matter will be closed. And this scheme has to be opted before 31st March 2020. Then you pay only the tax amount. But if you opt after 31st March 2020 but before 30th June 2020, then you will have to pay additional 10% of the tax amount to get a settlement done. So this is a welcome move and may result in unlocking of significant revenue for the government, as a lot of tax demand is outstanding and a lot of cases are pending. This scheme is announced yesterday only, and we've received the final notification yesterday. So this could be a good move for the government to settle a huge backlog of cases. Other changes was certain incentives have been given to startups. They were allowed to take a tax break for 3 years in any first 7 years of their operations. Now those 7 years has been increased to 10 years. There are ESOPs which a startup declares for their employees. The taxation of the same has been deferred, so that to ensure that the cash flow is not impacted in a startup kind of a scenario. In India, there is a requirement for not only getting your books audited from a company law perspective, but you are also required, if you are an Indian company or an Indian PE and you are also required to get your books audited from a tax perspective, which is known as tax audit. Earlier, the threshold was very low, that is 1 million INR. They have now increased the threshold to 5 million INR, and this 5 million INR threshold would be available only if 95% of the transaction, that is income as well as expenses, are non-cash. Further, due date for filing return has been extended by 1 month. So the government announcement was that they want the return filing process to be very simple in India, and hence they want the tax audit and the transfer pricing compliances to be carried out before filing of the tax returns. So whenever the taxpayer is going to file the tax return, all the data can be automatically picked up from the tax audit and the transfer pricing reports, and the entire data is pre-filled. So now the due dates are for tax audit and transfer pricing cases. The due date for tax audit and transfer pricing is 31st October of every year. So for the year ending April to March, the coming October would be the due date for tax audit and transfer pricing, and for tax return the due date would be 30th November, and for non-transfer pricing cases the tax audit due date would be 30th September, and for tax return it would be 31st October. So moving on, for indirect tax proposals, my colleague Shivendra would take you through the indirect tax proposal.
Thank you, Nikesh, and good afternoon, good evening. You're from India. I will be taking you through the indirect tax changes, which mainly comprise GST changes and customs changes. Starting with the GST changes, the first one being a minor change in the provision relating to taking input tax credit on a debit note. This is only an amendment brought in to cure a drafting error, whereby, as per the existing provision, input tax credit on a debit note raised could be denied to the recipient because, as per the existing draft, the due date for availing input tax credit could expire even before the date of the debit note itself. So this has been corrected now, and due date for taking input tax credit from on a particular debit note starts from the date of debit note rather than from the date of the original invoice earlier. The second amendment which has been brought about is government has empowered itself now to prescribe the manner and time for issuance of invoices for certain notified categories. The background of this amendment is under the GST law, for certain sectors, there are special provisions for issuance of invoice. For example, the banking sector is exempt from issuing a usual invoice if any other type of document as per the banking regulations is issued by a company. In light of the upcoming e-invoicing provisions, government has further, as a precursor to the move of notifying the rules, it has empowered itself to prescribe the manner and time for issuance of invoices for other sectors as well, including e-commerce. Another important change as far as the penalty provisions are concerned for offences committed under the GST Act. This is also an amendment which is seeking to correct a lacuna. Earlier, offences like supplies made without invoices or incorrect invoices or invoices issued without supplies. These kinds of invoices were typically committed by a provider of service or a supplier of goods, and the punishment was also restricted to the supplier in this case. However, many a times the benefit of or the input tax credit of such a fraudulent supply was always available to the input tax credit as input tax credit to the recipient. And under the existing law, the recipient was not held as a person liable for a penalty because he took the benefit of such a transaction. So this amendment has been brought about to state that any person who retains the benefit of any such fraudulent transaction and at whose instance or behest this transaction is committed would also be now under the penalty net. and the penalty would be equal to the ITC availed or the tax evaded or passed on, as the case may be. Another expansion in the scope of a penalty or the person who is defaulting is under section 132, which also prescribes for criminal prosecution. Earlier, the penalty was only restricted to taking input tax credit on an invoice or an incorrect invoice. However, there was no penalty prescribed for taking input tax credit without issuance of any invoice. So this has now been sought to be corrected, where taking input tax credit on even without invoice is now liable for punishment, and also the person who is receiving this credit or inducing this act to be committed has been brought under the penalty net. And the punishment in such case would and the punishment or the prosecution provisions would only arise where the fraud committed is more than INR 10 million. This also makes it very critical to avail ITC based on the correct invoice and correct place of business, and ensuring that all the conditions to avail the ITC are satisfied, as this time and again witnessed, even bona fide recipients who have not willfully committed any fraud could be under the scandal leading to unwanted litigation. Another couple of very quick changes are on the transitional credit. So when India transitioned into the GST law on 1st July 2017, accumulated input tax credits under the previous law were allowed to be transitioned to GST. However, there was a time limit that is up to only of 6 months, up to 31st December 2017. This was challenged in the courts by various taxpayers on the ground that this time limit has not been enshrined into the Act, but only brought in as a backdoor to the rules. And courts have been pronouncing judgments in favor of the assessees. To curb or to negate the effect of these judgments, government has retrospectively amended the law to provide that the power to impose a due date on availing such transitional credits has been sought to be introduced herein, and 31st December can now be said that it was the final date of availing transitional credits, unless an assessee was prevented from doing so due to technical difficulties. Another small change which the government has done, that any order that government seeks to introduce to remove any difficulties from the GST law, the law being still under a nascent stage, only 2.5 years old, the government has sought to give itself powers to remove any difficulties from the existing 3 years to now up to 5 years. Few very important announcements were made besides the legislative changes. It's important to mention them here. The first one being that a system of cash reward is now envisaged to incentivize customers to seek invoice. Many times it has been witnessed that the retailers, with the connivance of the customer, do not issue invoice to evade taxes on the last leg of the transaction. Now customers will be incentivized through a cash reward system so that they seek an invoice from the retailer. The contours of the scheme will be prescribed later. Second announcement is that the digital refund to exporters. So the background of this announcement is that the export incentive scheme for merchandise exports in India, which is currently operational, India may not be able to continue that, as due to a recent ruling of a court in the World Trade Organization, and hence from 1st April 2020, this scheme would be likely be discontinued, and hence government has brought in a new scheme called as the RODTP scheme, which is remission of duties and taxes on exported product, where the embedded taxes in any product would be refunded to the exporters. So taxes on electricity, VAT on fuel, and agriculture taxes are typical examples wherein where no refund or any credit of taxes is available to an exporter. These taxes will now be identified on a product basis and will be refunded to exporters. And it has been announced that this scheme will be launched in 2020 itself. Another important couple of announcements that have been actually reiterated by the government is that the e-invoicing provisions, which is a move to curb on the fake invoicing practices, which have been widely reported after introduction of GST. The government has said that this will be introduced in a phased manner in 2020 itself. Further, that the new simplified return filing system under the GST would also be introduced from April 2020. So this concludes the GST changes. We would now begin with the customs law changes. Customs law changes have been very widespread, and before beginning with the specific changes, I would like to state that government has continued with its trend of tightening customs duty and making the imports difficult by raising the customs duty rates to achieve its objective of Make in India, that is increasing domestic manufacturing and not be dependent on imports. The very big change in this is the introduction of a slew of provisions called as the administration of rules of origin under trade agreement. Before I begin with this change, it is a little bit important to understand the background, wherein India has signed various free trade agreements with many countries, and to grant such customs duty exemptions under this free trade agreement, usually a certificate of origin was acceptable, and on this basis alone the benefit would be granted. However, the past few years have seen investigations being opened by the government on various imports and questioning the authenticity of certificate of origin or actual value addition happening in the country of export. And various times the government actually took an action and suspended this tariff concessions on the basis of investigations. However, the courts always managed to thwart this or strike down this move of the authorities, stating that there is no provision in the law to do so, and the government could only take action based on the rules of origin prescribed under the bilateral trade agreements. The government has now sought to correct this lacuna, or we can also see this as a move to now go aggressively behind such concessions and make the importer liable to furnish information as to the correctness of the origin criteria. So government will now increasingly start questioning the importers themselves to furnish proper information and to evidence that the origin criteria has been really satisfied before granting any customs concessions. So any importers in India who are looking to continually benefit from such trade agreements should gear up and begin complying in advance and collecting information, as government can use this provision and ask for details before granting any customs concessions. The government has also given it powers to open any or to question any claim of preferential duty up to 5 years from the date of import, and also provisions of confiscation of goods and suspension of preferential duty has been sought to be introduced based on the information available with the department. It is to be seen that how these provisions would conflict with the procedure already prescribed in the origin rules, and whether the courts will take a divergent stand stating that the domestic law, the provisions of domestic law now introduced cannot override the agreements already entered into with sovereign nations by India. Second very important change is the government has given itself powers to prohibit import of goods on the ground of injury to the economy of the country. This power was only restricted earlier to gold and silver, but now it can be exercised with respect to any commodity. Uh, the government has also allayed fears in this regard, stating that this provision will only be used in exceptional circumstances. Another safeguarding measure is the introduction of powers for not only imposing safeguard duty where there is any on any injury to the domestic industry. So if there is any imports that are happening on a large scale where it is injurious to the domestic industry, earlier the government could only impose a safeguard duty, but now it has sought to be expanded, and safeguard measures such as tariff rate quotas can also be introduced. Government has also now imposed a health cess on certain medical devices covering being covered under chapters 9018 to 9022. This rate is to be the rate of this health cess is capped at 5% ad valorem, and it will not be levied where an item is already exempt from basic customs duty. Again, these are the measures to boost the Make in India initiative of the government. Another measure to curb evasion of customs duty is to expand the reasons where the government can introduce anti-dumping duty on any commodity, where even the criteria such as change in name of the product or imports happening in unassembled form just to evade imposition of anti-dumping duty is also now sought to be covered. The last point in customs changes are just an indicative list of goods where the government has either increased the duty rate on imports or removed the existing exemptions. So this was a major highlight of the finance minister's speech, where they have reviewed the exemptions, many exemptions under the customs law, which according to the government have served its objective, and these exemptions are no longer required. And all those cases have been reviewed, and wherever required, either the exemption has been withdrawn or the existing minimum duty rate is sought to be expanded by in the range of 5 to 20%. The key sectors being the food, basically chocolates. Another sector is patent leather, electrically operated vehicles, solar cells, footwear, and furniture. Government has also said that around September 2020, they will be again reviewing this list, and the exemptions, the list of exemptions to be withdrawn will be expanded. With this, we come to the end of the customs changes as well, and I conclude the indirect tax part here.
Thank you for the presentation, Nishit and Shimendra. We now invite all of you to type your questions in the chat box in the webinar panel for our speakers to answer. We shall take up some of the questions now, and for the rest, we shall email the answers to you. So our first question, one of the questions is,
the question is on the corporate tax rate, as to from when the corporate tax rate would be applicable. The corporate tax rate is applicable for the financial year 1920 and onwards, so it is applicable from this year itself. One more question is on the dividend distribution tax. The question relates to that what happens for funds which are organized as trust. So as I mentioned that if a trust is not able to claim the tax treaty benefits in the home country, it would be governed by the local laws of India, whereby the tax rate for dividend could be 25 to 27%. And and if it is able to claim the tax treaty benefits, the tax rate would be as per the respective tax treaty. I think so. Balance we can take.
Thank you, Nishit and Shivendra, for taking out the time to share your valuable insights with us. We hope that the insights shared by our speakers have been useful for all of our listeners. Thank you once again, everyone, for joining in.